This is Dr. Duru from Ahan Analytics with the market breadth. Last week, I said the stock market was all about oil. Well, now it's just all about war. And of course, oil prices are up because of the war. But now we have more and more cascading impacts from what's become an escalating conflict. Not only is oil jammed up in the Strait of Hormuz and fertilizers and other products that are needed for the global economy are bottled up at the Strait of Hormuz, but now we have infrastructure, even civilian infrastructure being destroyed and damaged and targeted. That means that the potential outcomes from this conflict just continue to broaden. And the market is choosing to get out of the way of this uncertainty. And we traders, investors need to take heed. And I'm also taking heed. And I'll talk a little bit about that when I go into the charts a little bit later. But my overall message is I just want to caution. I know it's so tempting. There's so much news and so many people commenting and so many people who claim to have some insights that we think that we can then intellect our way or think our way into a conclusion or a prediction. I say no. I'm not trying to do that, and I recommend no one else do that. I'm fine paying attention to the technicals. I'm fine taking the technicals with a grain of salt because of the uncertainty of the war, but I am not going to try to predict actual outcomes from this geopolitical conflict. And instead, like I've said before, risk management is just tantamount in this time and age. Okay. On the technical side, we're almost oversold. Near the end of trading, we got news that the U.S. was not going to consider ground troops. That sent the market higher going into the close and actually pretty much erased all of today's losses in the aftermarket. We'll see if that holds on Monday. If it does manage to hold on Monday, I'm going to have to treat Friday as if it is close enough to oversold. Otherwise, if we open down, then I am fine waiting another day or however long it takes to get to oversold conditions. All right, let's just dive right into these charts and you'll see what I mean. This is AT50, what I like to call above the 50. It's the percentage stocks trading above their 50 moving averages, my favorite technical indicator. It's a representation of market breadth. You can see here at the close, we got close to oversold conditions. Oversold is 20%. Why is it 20%? Because, well, market breadth rarely spends much time below there. And if you want more information, I've got a blog post on this at drduru.com/122. And you can check out my market breadth pieces and data there. But anyway, because the market rarely spends much time at oversold conditions, it's a great time to go bullish and to buy. Now, as I said earlier, the big caveat here is that the war has so much uncertainty embedded into it that I won't be able to be as aggressive as I'd like to be because the oversold conditions could basically continue to unfold. We are in bearish market conditions, and I'll show that in the indices with their breakdowns. And once you're in those bearish conditions, oversold can feel bottomless. I mean, this is the way we suffered, or the market suffered back last year, about a year ago, with the tariff drama and noise. All right. Now, also the caveat, of course, is that because the uncertainty is not just to the negative side, to the downside, the uncertainty is actually to the upside. And we saw some of that, like I said, at the close today. You can't really see it on the oversold chart here. I'll show that on the S&P 500. But there was a big rally in the last 15, 30 minutes or so of the market close. And it continued into the aftermarket. And basically, most of the losses for the day were rolled back. If I also see that most of market breadth's losses were rolled back and we open up positively on Monday, then I will consider this oversold condition to have been met, essentially. And I will treat it like the rebound. I'll treat it like an oversold rebound. All right. Now, the other caution I have is that the longer term measure of market breadth health, which I call AT200 for above the 200, it's had this steep downtrend. The primary downtrend used to be around here, and then I had to steepen it for basically all of March. And I'll just roll back here for a second. You can see that now AT200 goes all the way back to where it was trading last June. So this is a major breakdown for AT200, and it is also in bearish territory. I don't have oversold, overbought for AT200. I just have bullish and bearish. And right now, AT200 is bearish. The majority of stocks are below their long-term 200-day moving average. All right, let's take a look at the VIX. The VIX is also important right now because volatility is so high. And what you can see here is that unlike all these other previous episodes of volatility pops, the VIX has been elevated for this entire catalyst. So after the U.S. attacked Iran, on the first trading day after the attack, the VIX has not traded down to the downtrend at all this entire period. It is staying resilient. Now, mind you, it still also has essentially put in a top right here around 35. And you can see this big fade is still in place. So both the buyers and the sellers have a lot to prove. But for now, we have to assume that the VIX is still in an uptrend. And that's very dangerous for trading conditions, of course. Now let's take a look at the indices. And why am I calling them bearish? Well, the S&P 500 broke down Thursday below the 200-day moving average. Is that blue line. And it fell another 1.5% today, confirmed the 200-day moving breakdown. Again, caveat being the late breaking news. And in fact, let me go to the 15-minute chart so you can see right here. You see these bars here. This actually, I think, was the start of the bounce right here. And then for the next, let's just call it 30 to 45 minutes, the S&P 500 rallied back. And then, like I said, in aftermarket, it continued. So absent a positive development for that, the S&P 500 is bearish. Now, the good side of S&P 500 being bearish is that if it closes above the 200-day moving average, that's a clear buy signal, particularly coming off of oversold conditions. Okay, so let's make that clear. If the S&P 500 is bearish right now, it is below the 200-day moving average. If it gets above the 200-day moving average, it is back to bullish. And then it's even more bullish because it's coming off of oversold conditions, all right? Fantastic combination. However, the rebound could be capped, right? There's resistance from the 50-day moving average, which is now trending downwards, and it's that red line. We have this rounded top. I drew this in so that's very clear. With this 200-day moving average breakdown, we have, the S&P 500 has confirmed this rounded top. So the index is not in the clear until it can invalidate this rounded top. That's actually, it won't invalidate until it makes a new all-time high, but it first needs to get above the 50-day moving average to truly invalidate this now bearish trading condition. And what I also wanted to note is that you see how all these other previous incidences of market catalysts where the market rebounded quickly, the Greenland escalation caused the S&P 500 to come gap down, but then buyers stepped right in. Back here when there's a fresh flare in the U.S. versus China economic war, the S&P 500 lost over 2%, rebounded right away. The war has been a very different catalyst. And the irony of this catalyst is that the market did gap down as we would expect, but then it rallied right back and closed flat. And that was, of course, the wrong reaction. At that time, of course, people were hoping that it was just going to be another 1 to 3 day max event. And as this war has dragged on, the market's patience and tolerance and resilience has worn down. So that makes this catalyst very different. This is not a time for complacency. This is not a time for saying, oh, well, over time, the S&P 500 will trade higher. Well, yes, of course it's going to trade higher at some point. But in the meantime, we still have to manage risk. Okay, enough of the soapbox. Let's keep it moving. NASDAQ, I've already talked about the double top in the NASDAQ. The NASDAQ has been bearish for a while. I've called it bearish ever since it broke down below the 50-day moving average. And now this, it tried to hold the 200-day moving average, tried to hold the 200-day moving average support there. I'll just draw a quick circle. You can see right here, you can see it tried to hold on and it failed, right? It failed with this breakdown here. And the NASDAQ lost 2% today. I didn't see what happened in the aftermarket to see whether it also reversed most of its losses, but still, this is very much a confirmed 200-day moving average breakdown. It confirms the double top. It confirms the bearishness of the 50-day moving average breakdown. And the NASDAQ is just deep, deep, deep into bearish territory. And if we And actually, I forgot to mention, the NASDAQ is now trading right back to where it was in September. And that makes it a 6-month low. But you know what's even worse is that the Mag 7, the big cap tech stocks, let's just take a quick detour to look at MAGs, which is the ETF for the Mag 7. It lost 2% essentially today, but it's trading all the way back to where it was last trading in August. So the NASDAQ is actually outperforming on a relative basis the Mag 7. This is quite a turn, right? Because the 7 biggest stocks, the 7 big tech stocks, were basically driving all the market gains for quite some time. The Mag 7 actually topped out way back here in October, November, and has been drifting downward ever since. This is a warning that something has fundamentally changed in market sentiment and preferences. This is another reason why I can't get overly bullish about an oversold bounce. And the Mag 7 has a very tough time ahead on whatever bounce comes because it now has converging resistance for the 50-day moving average and the 200-day moving average ahead. All right, let's go back to the indices. IWM, this is the iShares Russell 2000 ETF. It is still outperforming on a relative basis from the other indices, and because it's still above the 200-day moving average. If I zoom in here, you could just barely see that there was a test of the 200-day moving average and there was a small bounce. In other words, IWM is still bullish long term, but it's probably going to be dragged down. I'm not too positive about it holding this support. But again, if we get that oversold bounce and Mondays opens higher, then I can get a little bit more positive. I got a little greedy and a little too overconfident in my typical IWM call spread trade. I was profitable here on Thursday when the IWM bounced back nicely from the intraday lows and actually closed with a gain of 0.7%. And I just assumed that great outperformance was going to be a precursor to more gains ahead. And I could have, I was looking to about doubling the profit that I had in the position. Instead, I lost about half of the value of the position. So that's my bad, poor risk management, and just basically overconfidence. It happens. And, I learned the lessons over and over again. All right. Let's go into the ETFs and the stock indices. USO, I don't need to tell you, oil remains elevated. There was this brief moment when oil reversed, and I think the news was that, that the UK was leading other countries to commit to cooperating in opening up the Strait of Hormuz, but oil bounced right back. USO up 3.5%. Needless to say, as long as oil remains elevated, the market is just going to be subject to volatility and it's going to be in trouble. At this point, I expect all of my fades of USO to fail, even though I'm keeping the remaining puts in place just in case, because again, the possibilities for the market right now are extremely wide. Now, gold. And this is GLD, proxy for gold, despite our gold shares. I was talking about how high oil prices have been driving down commodities. Well, gold has been no exception. It gapped down big time on Thursday, 4%, lost another 3.1% today on Friday. It is now getting dangerously close to this support level, which is the former all-time high at $403.55. As you know, I'm a gold bug, gold bull, so I took advantage of this drop to sell a put. I sold an April put at the $400 strike. Again, the only reason why I did that is because I don't mind owning gold here. Trust me. No, sorry, I shouldn't say trust me, because again, anything can happen. But if the war were to end on Monday, gold would definitely soar back up, because guess what? War is expensive. The U.S. the U.S. budget deficit and the debt is going to skyrocket more because of this war, and then all of the rebuilding that's going to have to happen either during or after this conflict. And gold has been mostly about the ballooning debt levels, and I think it's going to be the case again. And now, once the dust settles from this war, the inflationary pressures are also going to push hard on gold higher. Now, silver is a precious metal. This is the ticker symbol SLV, iShares Silver Trust. It's sort of supposed to be a safe haven play, but it's really more of a pure commodities play. It also gapped down. I speculated on it because it was well below its lower Bollinger Band. Again, that's the black line that defines 95% of price volatility around the 200-day moving average, which is the dotted line. I was actually profitable by the close, but then I went back to flat or slightly in the red with this 6.3% pullback to the Thursday intraday low. Unlike gold, I think silver has a lot more to fall if this support doesn't hold, and a test of the 200-day moving average at around 51.50 or so would be in play. Now, what's also pressing down on the precious metals and commodities, maybe in general, is interest rates. And the bond market is getting spooked by all these higher prices, the sustained higher price in oil, and the bond market is starting to extrapolate more inflationary pressures. Now the 2-year yield is going up, and the 2-year yield is typically indicative of monetary policy for the Fed. Watch my short or read my Inflation Watch blog for more on my commentary on the Fed. The Fed released its opinions on monetary policy on Wednesday, and it was pretty hawkish overall. The expectations for interest rate cuts have pretty much disappeared, and TLT, which I've been buying as a contrarian play, plunged 1.9% on Friday. It is now trading back to where it was last August. So my contrarian play is not working. Precious metals trades aren't really working. A lot is not working. And that should be expected because market breadth is so low. When market breadth falls as low as it does, particularly to oversold levels, basically there's almost nowhere to hide. And I'm sure some of you who are watching this, your longer term portfolios are just suffering because of this. What else is suffering mightily? The seasonal trade is essentially over for home builders. ITB, the iShares US Home Construction ETF, has had a rough week. It's going to be inversely correlated to, it's going to be directly correlated to TLT, which means it's inversely correlated to interest rates. It lost another 2.6% on Friday. It is now trading way back to where it was also last summer in June. I did finally have to trim one of my home builder plays on the seasonal trade, but this kind of price action, there are just way too many macro conditions that are going wrong for me to continue to say that the seasonal trade is in play. And I believe, I didn't do the calculation, but I believe now ITB's outperformance over the S&P 500 has also come to an end. That's another signal that the seasonal trade is over. All right, another ETF that's been in focus is IGV, the iShares Expanded Tech-Software Sector ETF. It broke, it broke down below the 20-day moving average. So this rebound off of the lows is officially over. I'm still going to look to buy back into this again. I've done a lot on this. I've written a lot. I've done some videos already. I pronounce this the SaaS apocalypse, not the SaaS apocalypse, because I think SaaS apocalypse has a better ring to it. IGV is basically, it drifted down. It's been drifting down now for, what is this, almost 2 weeks. So this tells me that the lows might be back in play. I'm just going to patiently wait for another opportunity to buy into this. I think this is going to be the ultimate contrarian play in coming weeks, months, and maybe even years. But still, let's just remind ourselves that this is a broken ETF, and it is definitely still bearish. All right, now let's just look at a few individual stocks. Because market breadth is so low, pretty much the picture for most stocks is going to be the same. So there's not a lot of point in me spending too much time on individual stocks. But I just want to point out a few signature things, right? Spotify, ticker symbol SPOT, had a nice rebound from earnings, broke out above the 50-day moving average, looked like it was in recovery mode. But today the pressure was just too much, and Spotify fell. Was a 6.6% on Thursday, broke down below the 50-day moving average. If I had actually been paying attention to any individual stocks on Thursday, I would have gone ahead and shorted Spotify. Oh, and speaking of shorts, I forgot to mention, last week I talked about, or maybe I wrote about, a few select shorts that I wanted to ride going into oversold conditions. Well, the irony is that I picked pretty much all the wrong things to short. Only one of them worked. I actually had to bail with a small loss on a few, and I'm holding on to one more that actually is in the green. So that says a lot about how hard it is to time, even when overall trends and market conditions should be in your favor on a particular trade. Here's another indicative thing of how weak things are getting. This is Applied Optoelectronics, ticker symbol AAOI. I was so ready to buy this stock because it set up perfectly on the 20-day moving average here. Let me go ahead and draw a little circle there. Right here, that test of the 20-day moving average was beautiful. And then, but I held off because I wanted confirmation, but the confirmation was so high, it jumped 7.3% that I didn't have a good risk reward entry. Then again, it printed another big pop right here. That was 10%, and I thought I missed the move. And then guess what? Today it plunged 14%, and it's also below the 20-day moving average. I only point this out to say that even the stocks that were outperforming and riding against the downward pressure of the stock market, a lot of them finally gave way on Friday. Again, no safety almost anywhere in this market. But I'm still going to keep my eye on AAOI because it had a great surge post-earnings and is looking like it's still going to be good, even if it tests the 50-day moving average for a bounce. Dell, on the other hand, Dell Technologies, I've talked about this one before. This one held out pretty well. I was pretty impressed. This is probably one of the better performing AI trades on a relative basis now. Although, here's the warning, it faded hard from its all-time high, intraday all-time high. So it's possible that this today, Friday, sure it gained 0.6%, still outperformed the market by miles, but this could be finally a topping action for Dell, but I still have my eye on it because it had such a great, strong post-earnings move, 21.9%. Finally, again, in the theme of there's no place to hide, XLV, the State Street Healthcare Select Sector SPDR ETF, it's been selling almost straight down all of March since this war began, and now it's testing 200-day moving average. I had this on my buy list because if it bounces from here, I want to add more. I already have a position in it, but I want to add more. But I am very surprised that even XLV, which I don't think has anything to do with this conflict, is selling off. This again means that there's been nowhere to hide. All right, last thing I want to run really quickly. I was really excited at the beginning of last week about a very strong bullish signal, the bullish engulfing. Let's just take a quick round trip on the lessons that I learned from this. I'm going to start with the best performing ones on the day, and we're just going to run through this very quickly. I won't even say the stock names because I'm going to focus on the patterns. Some of them I will. Applied Materials, AMAT. This is still doing relatively strongly. This happened to be one of the positions I picked, so that's all good. And note how in these charts that this is the bullish engulfing that I pointed out. This was back again on March 9th, and AMAT has actually held its 50-day moving average this entire time. So this is a powerful confirmation of why it pays to buy only the strong stuff when the market is weak. So this is Applied Materials, AMAT. This bullish engulfing pattern was above the 200-day moving average. This is on semiconductor. It still is. ADI, this one failed, right? It's lower than the bullish engulfing pattern and it's below the 50-day moving average. BWA is trying to hold on. This is one I bought. Cirrus, CRUS, it's doing well. It's above the 50-day moving average. And notice that the semiconductor stocks that I picked out from that bullish pattern are all doing pretty well. Most of them, I should say. IE, big fail. I bought this one. I'm going to hold on because it is. I like the overall company, and I think it's going to rebound strongly whenever things come back together. Could be a big mistake, but we'll see. Brunswick Corporation, BC, it's holding above the 200-day moving average, so it's being resilient. AME, this one is a failure. Caterpillar is on the edge. This one I bought into, and if it breaks below 660, I'm going to have to stop out just because the potential for a lot of losses all the way down to like 540, which is the 200-day moving average, is just too great to bear. Modine, I bought that, of course, and I've written about this one. It's hanging in there. Element Solutions, ESI, hanging in there. And this is a fail, ABT. This is one I bought. I'm probably going to have to stop out. I almost stopped out today, but I want to see whether it can recover. But it doesn't look good. ASX, hanging in there. Big fail on Trade Technologies. Form factor, hanging in there. In fact, it's still positive from that bullish setup. AEIS, positive from that setup. DIOD, positive from that setup, and I own these shares. BHE, still, well, actually, no, it's not quite positive, but it's hanging in there, holding the 50-day moving average. And we know that these stocks are very rare, right? There's only about 20%, 21, 22% of the market is above its 50-day moving average. This is one of them, barely. Teradyne is another one of those that's barely, that's in that small group, elite group of stocks. And it's kind of flat with its bullish engulfing pattern. Quinity, I think that's how you pronounce it, electronics, Q, it's hanging on the 50-day moving average, but it's below the bullish setup. Now we're going to get into the bad ones. I bought this one. I think I actually like this stock enough that I made a longer term commitment. So I'm going to wait to see whether it tests the 200-day moving average, bounces, and then it gives me an opportunity to buy more. This is RRX, but this is a fail in terms of the original bullish setup. LSCC, it's hanging in there. I actually bought it on Thursday thinking that it not only was hanging in there, but it was about to run up to 100. That didn't work out, but I'm holding on because the bullish engulfing pattern is still in play. And now we're back to applied materials. So you could see, again, I wanted to just go really quickly through those because, again, the main lesson is when you pick the right strong technicals, they can withstand a lot. And that was a big lesson also even for me, that when it's time to buy the oversold conditions, and again, it looks like next week there'll be some sort of buying opportunity, I am going to focus and hone in on only those strongest stocks. What will be those strongest stocks? Absent a specific technical pattern, it'll be anything above the 200-day moving average, basically. And I want to see hammers. I want to see bullish engulfing. There are a whole bunch of others that Swing Tradebot has. And so please subscribe if you want to get alerted when I post a video about those plays and positions. Share and like this content so the algorithm knows what's up. I can get more visibility on these things. And if you have any questions or feedback, put them down below. And I'll just conclude with a quick look at Swing Tradebot, which is responsible for helping me pick good stock setups. This grid says that sums up the theme, right? Know where to hide. All of the trends are red and down, except for what? The Russell 2000, which long term, and I showed that earlier, it's still up, but this could flip down if things don't hold up this week. In fact, if I were to go down and show you the other technical indicators in Swing Tradebot, you can see that things are about as bearish as can be, which makes me think that a rebound has to be in the works. All right. Thanks a lot for hanging in there with me. Take care, everybody. And I will see you later on the next one. Take care.